Good morning. It's Monday the 19th. Here's today's agenda. Will Europe dust off tariff retaliation? How far will stocks and the dollar fall? And will China boost domestic demand?
It is risk off across these markets on some of those issues. Of course, the driving factor is President Trump's threats of 10% tariffs on EU partners, 8 nations, of course, including France, Germany and the UK. S&P futures then pointing lower by 0.9%. It's a national holiday in the States. European futures pointing lower by 1.5%. It's going to be a challenge day for European equities on risks of a trade war between Europe and the US. Gold and silver getting a bid. The yellow metal surging 1.7%. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. This is the opening trade. It is Monday, the 19th of January. President Trump puts tariffs and tariff retaliation, perhaps, firmly back on the agenda, very much linked to geopolitics around Greenland, of course. In terms of market response, very much risk off. Looks as if European stocks could come off worse. But in terms of currency markets, maybe the dollar very much the loser, certainly on day one. Let's come back to the markets in just a moment. Let's get an update from Bloomberg's chief Europe correspondent for Bloomberg TV, Oliver Crook, who's in Brussels and can talk us through the latest reaction from European leaders to what we heard over the weekend from President Trump. Good morning, Ollie.
Hey, Anna. Yeah, just to recap what we heard from President Trump, it's that 10% tariff threat that would come into effect on February the 1st for those 8 nations that have shown sort of exceptional solidarity with Denmark and Greenland by sending, again, a very symbolic number of troops there to the island in order to boost Arctic security. Those are Norway, Denmark, Sweden, France, Germany, the UK, Netherlands, and Finland. And then that number will go from 10% to 25% starting on the 1st of June. Now, we should say that the response from European leaders has been pretty universally consistent. It has been that basically there is full solidarity with Denmark. There is going to be full solidarity on the ideas of international law, on the ideas of sovereignty, but also that they're willing to negotiate and talk to the United States to find any sort of overlap on common interests like Arctic security. The question is this a sort of circle that can be squared, so to speak? I mean, we have now an emergency meeting of European leaders that will be here in Brussels on Thursday, that will be assembled in order to discuss the path forward. We know there are a few things on the table, including the retaliatory measures that were suspended last year, almost 100 billion euros worth of goods that would retaliate against the United States if they cannot find a diplomatic solution. We should stress that the Europeans would like as their primary goal to find a diplomatic solution. They have the opportunity to talk to Donald Trump when he arrives in Davos this week. That being said, I think that the fear that many Europeans had from the very beginning is that any trade deal with the United States is not final. As a consequence, you're always going to have these trade issues whenever there's an issue with the President of the United States, at this point on Greenland. So at this point, it is hard to see how the Europeans cannot respond. There will be some time given until February the 1st. They will wait till then in order to get a response. But at that certain point, they may have to do something that will carry, of course, large economic risk for them, to say nothing of the risk to Ukraine, which still is so dependent on American intelligence and military support in terms of selling those weapons. So all of those things will have to go into a very complicated calculus for European leaders when they assemble here on Thursday.
All of that very much in the mix then as we look for European response. Ollie, thank you very much. Bloomberg's chief Europe correspondent, Oliver Crook. There'll be more with Oliver as we go through the programme, of course. He'll be back with more detail about what we've heard from both sides a little bit later on in the programme. I suppose, Tom, we have to start the programme asking whether these tariffs will ever come to pass. I mean, we don't have any details as to how this tariff would be applied. We're waiting to hear from the Supreme Court already on IEEPA tariffs. Was President Trump going to rely on the IEEPA route to get this through? That will be something we'll be watching. And how do you tariff some countries in the EU and not others? The EU holds the competency for trade, and so technically it is not possible to put tariffs just on France or Germany or certain Scandinavian countries. So, I mean, and those are just the starting questions, I suppose.
Yes, and it was interesting to hear from the leader of Italy, who is not, of course, on this list of countries facing these additional tariffs, Meloni coming out and advocating on behalf of those European nations. So whether or not that continues in terms of that relative unity amongst European nations is really important. You're absolutely right to flag the Supreme Court and under what jurisdiction or under what rules President Trump could impact and impose these tariffs. February the 1st, again, 10%, then June, 25%. Bloomberg Economics pointing out if we get to June on 25% on already 15%, then you're at a higher rate than China in terms of the tariffs that US would be imposing on European exports. Where are the constraints to President Trump at this point? Is it the markets? Is it the bond markets as they were come Liberation Day of April of last year? Is it domestic politics?
Yes.
Is it Republicans themselves? Or is it retaliation from Europe? I'm watching for the next response from President Trump in terms of social media response, as he hears about these potential retaliatory moves from Europe, then we've seen this playbook before. He'll just come out and say, OK, we'll raise tariffs 20%, 30%, 50%. We saw that in terms of the China play. Is that where this escalates to?
Yes, we have seen these tariffs being piled one on top of the other, to your point, so maybe that is the direction of travel for the US. And yes, we have our reporting, as Ollie said, is that Europe is considering dusting off the 93 billion, or the tariffs on 93 billion euros worth of imports from the United States into Europe, which they have approval for already. That was from a previous tariff spat, which we remember well last year. Let's talk about how the markets have responded to this then, Tom, because very much broadly risk off. So the dollar is down and the euro is up. And that in itself is really interesting because it does seem as if the market is thinking that this is, from an FX perspective, more of an own goal, very much ties into the de-dollarization and a political risk premium that people have been talking about putting in on US assets.
The lack of trust for the Trump administration and from the US. Deutsche Bank putting out a note over the weekend saying and pointing out that European governments could cut their holdings of US assets. European governments are the largest owner, $8 trillion of US bonds and equities. That's almost twice as much as the rest of the world combined. We are seeing those haven bids for the likes of gold, for silver, but also the Swissy as well. And our MLive team pointing out that the Swiss franc is potentially the key beneficiary or one of the main beneficiaries, particularly Switzerland's not being targeted and moves into the Swiss franc. So you're seeing those moves, gold, silver, the Swiss franc, and of course European equities falling. But we're going to see some divergence between where the pain really lands across the European equity space.
Absolutely. We'll certainly watch those big exporters from the luxury sector, the auto sector. Certainly some of the pain will no doubt fall there. And the European futures picture does look more dire than the US futures pictures. That's worth saying. In terms of havens, how will European bond markets respond? We have not seen, actually, Asian bond markets acting as a haven, but then Asian equities also didn't sell off very much. So maybe this is a question for 24 minutes from now, where we see the start of the European bond market trading. And futures are suggesting that we will see a bit of a bid into bunds, into German government debt as a result of this. We need to talk about China as well, because we've had considerable data out from China, which really fills in some blanks around the Chinese economy for us.
So China hitting that 5% GDP target for 2025, the export engine really kicking into gear and helping to offset the weakness in the domestic economy, real estate, and of course the deflation story that's continued for 3 straight years. The question then into 2026 through the rest of this year is what levers is the government in Beijing going to be pulling to try and support that domestic consumer that remains challenged, and also of course what is the deflationary impact of that massive outflow of Chinese exports into countries and nations like Europe, but also Latin America as well. One of the key data points that stood out to me was the falling birth rate as well, and that longer-term challenge for China.
Yeah, absolutely. Just one of those longer-term challenges. And in terms of that split between export and domestic, yes, the export engine really continuing to power through, despite the fact that we've seen Trump putting on tariffs against China. They found simply other destinations for those products. And we've heard that become an issue for policy setters here in Europe, haven't we? To your point, you know, the Bank of England very much putting that on the agenda. And similarly, European leaders have been talking about this. So, yeah, where will the response be on the domestic side for China? Expanding consumer help in some particular parts of the economy is something that's being talked about. Will we see further interest rate cuts, maybe the 7-day repo in focus? That's certainly something that Bloomberg Economics is thinking about.
OK, let's tell you what else we have got coming up on the show today. Kamakshya Trivedi, Goldman Sachs' chief FX and emerging markets strategist, will get their views, of course, on how to position given these additional tariff threats. John Turek, JST advisor, CEO, will be coming onto the show as well. Again, the main thrust of the questions has got to be how all of this impacts the global markets and how to think about what is now a risk-off scenario for equities, or whether or not this opens up some opportunities. Leslie Vinjamuri, with the geopolitical hat on, Chicago Council's CEO, will be giving a perspective as well. We're also going to be speaking, and Anna just talked about the ECB, we're going to be speaking and hearing from Mario Centeno, the former president of the Eurogroup and former governor of the Bank of Portugal, and getting a take there in terms of how the ECB may react to this challenge to the European economy. And from the World Economic Forum, of course, we're going to hear from InvestCorp Executive Chairman Mohammed Alardhi. Of course, Davos and the World Economic Forum underway. Here's what else to be thinking about through this week then. The week book and the focus, of course, today. The World Economic Forum does start. US markets are closed, of course, for a national holiday. And on Tuesday, we're going to get jobs data from the UK. We'll also get earnings in terms of the Netflix story then. We'll think about subscriber numbers. On Wednesday, UK inflation data is going to be coming through. Will that adjust views on the Bank of England and how the central bank here responds? Warner Brothers will be coming through in terms of the shareholder deadline. That's important, of course, coming back to the Netflix story. And Trump will be addressing Davos. That's the big one. The speech, of course, by President Trump on Wednesday. On Thursday, we're also bringing in GDP data, inflation data as well out of the US, and earnings from Intel, now with that 10% government stake, and the BOJ with their rate decision on Friday.
There is a lot happening, isn't there? I mean, President Trump in Davos would be enough for anybody's week ahead agenda, wouldn't it? I mean, that's certainly going to be one of the events that dominates, isn't it? But then in amongst that, we have central bank decisions from the BOJ. Yes. We have data points to watch out for, certainly in the UK and in the US. I mean, it's the third estimate of US GDP, but we'll focus on it nonetheless. And PMIs out of Europe. So a really up-to-date picture on how the market is, or how the market is thinking, how businesses are thinking about the European growth story.
Yeah, the Japanese Prime Minister is expected to be speaking in the next couple of hours as well, Prime Minister Takaichi. So we'll see if there's any more detail in terms of potential election and how that factors in. We know the politics is already factoring in terms of the moves that we're seeing, particularly in Japanese bond yields, higher on expectations of more stimulus as well. The BOJ's decision on Friday.
Let's tell you some of the other stories that we're keeping across this morning. A high-speed train has derailed, jumping onto the opposite track and slamming into an oncoming train in southern Spain, killing at least 21 people. The crash happened last night when the tail end of a service travelling from Malaga to Madrid went off the rails near Cordoba. Spain's transport minister called the crash, quote, a truly strange incident because it happened on a straight stretch of track that had been renovated in May. Chancellor Rachel Reeves is set to say critics of the UK's capital markets were wrong as she heralds a, quote, new golden age for the city. She's set to speak at the London Stock Exchange today as new rules kick in to make it easier to raise public capital in Britain. Listed companies will now only need to produce a prospectus if they are raising 75% or more of existing share capital, up from 20%, with other measures to cut paperwork and costs also coming into force. And Tom briefly mentioned what's happening in Japan. Japan's Prime Minister Sanae Takaichi is set to lay out her plans for a temporary cut in food sales tax in a press conference today as she begins to campaign ahead of a snap election likely to be held as soon as February the 8th. The Prime Minister is expected to show a more fiscally cautious stance compared to a new opposition party that said it's aiming to permanently eliminate the food sales tax.
OK, coming up, LVMH is downgraded at Morgan Stanley, which sees little near-term upside for the luxury giant. We're going to check in on its shares at the open, of course. Plus, President Trump grabbing the spotlight as the global elite descends on Davos. We're going to explore how his latest tariff threats will shape this week's discussions. Up next, we're going to check in on markets as the Greenland drama boosts the haven trade. If you have any questions of your own for our guests, send them to us on IB plus BBTV Go. This is Bloomberg. Welcome back. We are a little under 45 minutes from the opening trade this Monday. European futures down 1.6%. President Trump's trip to the World Economic Forum in Switzerland this week set to be nothing short of dramatic, of course, after these announcements around tariffs. That's as the US president shakes the foundations of both the EU and the NATO alliance in his dogged pursuit of Greenland. For more, let's bring in Bloomberg Horizons anchor Jemana Pasechi, who is on the ground for us in snowy Davos. Jemana, this is going to be quite the build-up to Wednesday.
Absolutely, Tom. And you may be surprised to hear that the theme of this year's dialogue, this year's Davos event, is the spirit of dialogue, which, again, is controversial in itself, given you have one person in particular who's coming to upend what you could argue is the global world order. But even the World Economic Forum themselves will talk about the headwinds associated with multilateralism and the fact that there is declining trust in institutions, there's a lack of respect in the rule of law. The top two risks that they cite in the Global Risk Report, number one is geoeconomic fragmentation, and number two is state-armed conflict. So we're looking at a very different world today than we were in prior years. And gone are the words that are typically associated with these Davos forums. And typically you'd be talking about stakeholder capitalism or social equality or fair taxation, sustainability. Gone are a lot of those words that are associated with quote-unquote the woke agenda. And our reporting, a lot of the reporting into this was that the World Economic Forum had to sort of sideline some of those issues to make space for the massive U.S. delegation that's descending on Davos in a couple of days' time. So President Trump will be giving that speech on Wednesday. He is likely to address a lot of the political issues back home, domestic issues. It's going to be a big year. The midterms are coming up. And, of course, the developments vis-a-vis Greenland, the tariff threats that are being leveled at Europeans, and the big test of NATO as well, in addition to some developments over the Middle East. Let's not forget that they announced the membership of the Board of Peace over the last couple of days. His special envoy to the region, Steve Witkoff, is going to be accompanying him alongside Jared Kushner as well. Huge representation from the U.S. And I was talking about this earlier. They've actually taken over a church just outside the Congress, this sanctuary, and it's now called USA House. And there are signs everywhere saying 250, and of course it is in recognition of the 250 years of independence. So expect that to feature heavily as well. But isn't all just about Trump? I should also reiterate that there is a huge representation this year at Davos as well. It still has its pull. You have over 3,000 leaders, 65 heads of state, 6 out of the G7 leaders are expected to be here too. There are going to be speeches from President Macron tomorrow, so watch out for that. Ursula von der Leyen will be giving a speech too. The Chinese vice premier also giving a speech tomorrow as well. So let's see if they have anything to say about the détente in trading right now between the U.S. And China. And then Thursday, we get perhaps the first response out of Europe to that Trump speech with a speech out of Chancellor Merz from Germany too. So there's a lot to look forward to this week. Surely there's going to be a lot of emphasis on Wednesday, but alongside that, there will be other conversations going on. And then also, don't forget tech as well. Heavy representation from the tech world too, with the likes of Jensen Huang here, Satya Nadella, alongside the founder of Anthropic. So all of that to look forward to, Tom and Anna.
OK, Jemana, you and the team are going to be kept very, very busy indeed. Jemana Pasechi on the ground for us at the World Economic Forum. Jemana, thank you. Stay tuned, of course. We're going to speak to key newsmakers, as Jemana was suggesting, from Davos throughout the day, including InvestCorp's chairman, Mohammed Alardhi, and Franklin Templeton's CEO, Jenny Johnson.
OK, now we've talked about the markets and their response to President Trump's tariffs, the tariff threat. We've seen a fall in US and European stock futures. We've seen havens being bid, gold and silver moving higher. Let's talk about what's going on with FX markets, of course. That's going to be a big focus for us this morning. Let's get more on the FX market story. Kamakshya Trivedi joins us, Chief FX and Emerging Market Strategist at Goldman Sachs. Good morning to you, Kamakshya.
Good morning.
So let's talk about the initial response in markets, which is dollar down, euro up. Does that make sense, and does that endure?
I think that makes sense, and I think that endures as well. I mean, I think if I step back and think about our broader global outlook for this year, the dollar is still an overvalued asset. Less overvalued than at the start of last year, but it's about 15% overvalued coming into this year. So there's a kind of natural, gravitational pull towards a weaker dollar. But what we've also seen is that in an environment, and we've had 2 weekends of this now, where you once again see kind of disruptive U.S. policy, where, the shine around, U.S. assets can be questioned a little bit. I think the dollar tends to depreciate on that. That was true around the sort of Fed issues last weekend, and I think it's going to be true around the tariff issues again, following from this weekend. I think that this means that the dollar is going to be somewhat weaker as we go through the week.
OK, so 116.34 is where we trade. The dollar a bit weaker, as you suggest. Does that hold if we see retaliation from Europe? So if this takes a step up, if Europe retaliates, and then if we see further response from the White House, will that dollar weaker, euro stronger pattern hold, do you think?
I think in a broad sense, yes, although I don't think the euro is going to be the primary beneficiary of this, right? I mean, the euro, for us, fair value is something like, 122 or thereabouts. We did a lot of work towards that last year, so there's a little bit further for the euro to go. I think the main safe haven at a time like this, if you see that back and forth in the tariff negotiation or the trade war, however we want to describe it, I think it's going to be the Swissy. Euro-Swiss, stronger. I think that's a safe haven of choice at a time like this. It's, been correlated with gold. It's sort of exempted a little bit from the current sort of round of tariffs. So I would expect the Swiss to be the primary beneficiary, but in a broader, weaker dollar backdrop.
What levels are you looking at for the Swissy? Because we know the SNB is going to be cautious about Swissy strength.
Yeah, I mean, I think that, in general, if you didn't have these kind of risk-off events and these kind of threats, I would say actually the broader backdrop of stronger growth across the world, equity markets doing well, would lead to Euro Swissy moving gradually higher. But I think given what you're seeing, I think it's natural to expect Swiss to be the primary beneficiary. You can go back towards the kind of, Euro Swiss going back towards the low 90s again. Yeah.
But they step in. At what level does the S&P step in?
I'm not sure that there is a particular level that they're going to sort of, really try and defend. I think it depends on, what else is going on around the world, what else is going on in macro markets and in the domestic situation in Switzerland. But I think that is, the one to watch.
Can I ask about Europe's response with regards to dollar assets? Deutsche Bank had a note out over the weekend talking about Europe maybe buying fewer treasuries, buying fewer dollar assets generally, not necessarily because of a concerted decision to do so, but maybe just the sum of many small decisions to do so. Is that something we need to watch for when it comes to treasury markets? Is that a vulnerability for the US in this play?
I think it is something to watch for, and I don't think it's just, treasury markets or something, like you say, deliberate coming out of governments. I mean, if you remember, after Liberation Day last year, you had a wave of, European assets, both being hedged and the marginal dollar not being invested in the US, but being more diversified across the global asset complex. I think that is going to continue. That is a kind of, something that is a longer running thread. We think it makes a lot of sense for investors to diversify across markets, given the more balanced return prospects that we expect anyway. That goes in waves, and I think what has just happened over the weekend is probably going to prompt another wave of that kind of diversification and hedging of US assets. And it's not just bonds. I mean, if you think about the US current account deficit, in recent years, a lot more of the funding of that current account deficit has come from the equity side. A lot of the sort of demand for tech exposure, the US exceptionalism there, I think has been a key driver of the dollar's rich valuation. As you see some reversal of that, I think you're going to see the dollar valuation erode, which is another pillar of our weaker dollar view.
When you think about reallocating out of the US, and we talked about the euro and the Swissy, in your world of emerging markets as well, who are some of the key beneficiaries that could see some upside as a result of weaker dollar?
Yeah, I think there's a sort of a couple of groups of countries in emerging markets I would highlight. I mean, one is obviously, China and North Asia. They have been some of the primary beneficiaries, if you like, also of the tech trade, right? Like, I think they look at places like Korea, up already 15% year to date, Taiwan, China, one of the strongest fixes this morning. I think so that is one group of countries where I think people will be looking to diversify. And it's not so much reallocation, but like, where do you invest the marginal dollar in a kind of more diversified basis? But then I think there's also strength in some of the more domestic stories that have been somewhat lagging. I think India is a good example of that. I think we do expect to see a pickup in earnings there. We do expect to see sentiment there shift as well. South Africa is a great emerging market story, one of the best sort of fiscal improvements going on there. I think a lot of people like the bonds. We like the equities as well. And then I would finally flag Brazil. There's not many other places in the world which is going to have a big rate cutting cycle this year. Brazil is one of them, 15% rates, 5% inflation and below. We think there's going to be rate cuts. I think that's going to support the equity market as well.
Okay, just very briefly, Kamachi, how many cuts from the Fed this year?
We have another 2 penciled in.
Another 2?
Yeah.
Okay, so as per the market, pretty much. All right.
Much.
Kamachi, thank you.
Okay, Kamachi Trivedi, Chief FX and Emerging Markets Strategist at Goldman Sachs. Thank you for that take on how to think about the FX markets in this moment of additional trade uncertainty. Coming up as Trump rocks Europe with a new tariff threat, we're going to be speaking with Maria de Mertis from the Conference Board on what is worrying CEOs this year. I suspect one question may be tariff risk. Stay with us. This is Bloomberg.
Welcome back. This is the opening trade. We're 30 minutes away from that opening trade. The first chance to see what cash equity markets here in Europe will do with the latest Trump information, Trump threat over the weekend. President Trump then threatening to put tariffs on eight countries within Europe because of standoffs around Greenland. What does that do to risk appetite? Well, it sends it lower, certainly for European stocks. The futures picture looks weaker. It will look divergent, though. Maybe luxury stocks, other big exporting names in the auto sector, for example, in focus. And so CAC 40 futures are weaker by 1.9%. FTSE 100 100 futures, different sectors in exposure there, and that particular market not expected to take the brunt of this. But we are expected to be weaker broadly, down 1.5% on Euro Stoxx 50 futures right now. Bond markets then acting as something of a haven, not at all tenors, but certainly at the short end of the bond market curve. You see evidence of this. So things looking a bit more stable at the 10-year horizon. But if I click into the World Bond Market page around Germany, I can see that we are seeing some buying in particular at the 3, 5, 7-year horizon, so the sort of belly of the curve, and actually at the 2-year, at the short end as well, but not a huge amount. And we see yields, Tom, down around 3 basis points at the short end of the German curve.
OK, reaction there in the bond markets to the latest threat from President Donald Trump. Again, threatening to trample over deals he had already struck with the EU and the UK, of course, and risk reigniting trade tensions. The Conference Board has released its 2026 C-suite survey, identifying uncertainty as one of the top challenges keeping CEOs up at night. And as if to reinforce that, of course, the action and the threats from Trump over the weekend. Let's bring in Maria de Mertzis right now, Economy, Strategy and Finance Centre Europe leader at the Conference Board. So, Maria, a reminder of the uncertainty facing CEOs. What is your reading of how this could rewrite our outlook for the global economy on the back of these renewed threats around tariffs, with all the caveats, of course, in terms of how it unfolds from here?
I think what's interesting about these tariffs is that they are not used as economic instruments, which is what tariffs are all about. You're trying to correct an economic unfair point that has been done by an economic partner. Now, tariffs have been used as sanctions, and the reason behind sanctions, the rationale behind sanctions, is to change economic behavior, to change behavior of some sort. And this is exactly what we see from the US. And of course, that creates an incredible level of uncertainty, which is, of course, what CEOs are worried about globally. And it's not about the long-term trends. They're worried about the uncertainty that we face from day to day, which is, of course, preventing CEOs from making any decisions in the long run. And that, of course, is a huge problem for businesses.
What is it doing in terms of constraining investment decisions then, Maria?
Oh, it's totally paralyzing CEOs from making investments. They're worried about having to increase prices. They're even worried about financial planning and what new business model they're going to have to look for in order to generate profits this year. So this is really affecting fundamentally the operations of businesses across the world, but certainly in Europe as well.
Good morning to you, Maria. How would you expect Europe, as we watch first President Trump, what he had to say over the weekend, and now watch Europe for a response, how would you assume Europe is going to respond to this?
I think things are going to get tough, actually, moving forward. In the previous tariffs, there were a number of voices that were asking for the European Union to use what is called here in Brussels a bazooka, which is the anti-coercion instrument. And it can actually be a bazooka. I think those voices are coming back to say, I told you so. And I think there is a lot of arguments now that we should be using this anti-coercion instrument, which is effectively going to penalize US firms from actually operating in the EU. And perhaps the most interesting reasons why this has gone away is because the deterrent, the reason why we were not using the coercion instrument, is no longer valid. And that is the defense guarantee from the US. I think there is a great concern here in Europe that there is no US defense guarantee here. And that, of course, means that there's nothing to lose now by using the ACI, apart, of course, from escalating the trade war. But on the defense side, that doesn't hold anymore. Nobody believes here in Europe anymore that the US is a reliable ally when it comes to supporting the Russian threat. And therefore, if we were to use that instrument, that's not going to generate anything different. And that, I think, is the one reason why we might be seeing the anti-coercion instrument being used in the next days.
Yeah, I mean, that's interesting. Maria, we've heard from ambassadors from the US administration recently who say, look, the commitment to NATO is still there, but I take on board everything you're saying about the conversation in Brussels and around Europe. Is there a chance that this conversation helps to unite domestic agendas within Europe? I'm thinking here politically, but this will have an impact on the economics, of course, as well. We've seen populist parties around Europe, from France, Germany, the UK, all saying that this crosses a line and sort of puts them very much more on the same page as more mainstream parties within Europe.
Indeed, I think when it comes to difficult moments, the European Union tends to unite and actually very fast. And I think we are coming to one of these points again, because it is actually threatening sovereignty, and that is fundamental for the European Union. It is fundamentally for any country. If there were to be a real threat on Greenland, either through tariffs or any other reason, then I think that will be what I would call a Rubicon that is going to unite the European Union, just as we united back in the Corona days, or indeed in the financial crisis. I think this is one more of these moments.
Yes, so if this creates more space for cohesion, for Europe coming together, Maria, will that be basically about a defence conversation? Will that just dominate? Or will there be room to have conversations about the European economy and how to help it function better?
Well, I think both are important. But if there were to be a real defence concern or security concern, of course that will take precedent, right? And the question is, can we move faster in Europe? I think we have started the conversation in the defence. We are doing things jointly. I think we can do a lot more by either spending more together or by organising a joint army. I think that conversation will only become more crucial in the coming days, of course, depending on what the US position is, and of course what Russia does. I think the economy will remain in the minds of everybody, given that we're still not at war, at least not an actual war. But I think defence will always take precedence.
Maria, if we do get to a scenario where this is an EU-US economic trade war, does the EU lose?
Well, it certainly doesn't gain because nobody does. I think there won't be any winners from trade war. There will only be losers. The question is who loses more and therefore who backs out more. The European Union is a very big open economy, and the US-EU relationship is the biggest economic relationship, trade and investment. I think both parties will lose a tremendous amount, but given that the EU is bigger and more open, it probably will lose more. I think that is just a fact, and it is a reflection of the model that the European Union had used in the past, which is, open economy, big and long supply chains, and a multilateral system that helps that. If that unravels, I think the EU will lose more than the US.
Maria, from your conversations with CEOs and the surveys that you do, it seemed as if April last year, the business community really thrown by the tariffs that were put in place. But as the year went on, there seemed to be a sense talking to business leaders that maybe they were adjusting to a new normal, which was more volatile. There was a lot more policy risk out there and political risk. Does this set us back? How do you think this will be interpreted by businesses?
Oh, I don't think actually that businesses ever thought that this was the end of it. You see it in the reflection on the uncertainty, in the way that they're organizing their business decisions for the coming year. I think 2026 would just be as much about tariffs as 2025 was. And business leaders are preparing for this. They cannot plan easily, and they know that this will be as a turbulent year as it was last year.
Do you think, in terms of that resilience then, that's a pretty interesting statement. You think 2026 is going to be as much about tariffs as 2025 was, and that CEOs and corporate executives are preparing for that. Because to Anna's point, we have seen that relative resilience in terms of these companies being able to adapt and find new markets and absorb some of the cost. What is the breaking point for corporates on this tariff and trade uncertainty?
I'm not quite sure what you mean by a breaking point. I think planning is crucial.
I mean, how long does that resilience last? I mean, and how do they adjust to this?
The adjustment to this, I think, is through looking for new business models. And I think that is what they're telling us. Some of the resilience will also come through having to increase prices. They're worried about that. And of course, that will have knock-on effects on inflation and, of course, on monetary policy. But I think that is very real now. They will be passing. This 2025 was a year that business leaders didn't necessarily pass on the cost of the consumer. I think 2026 will be different. They will pass the cost of the consumer, simply because that feeds into the resilience that you're talking about. Is the only way that they can actually survive some of the shocks that they're finding. But looking for new business models, that was actually something very interesting about this survey, that they're needing to rethink financial planning. They're needing to rethink which markets are we going to reach out to. Everything is up in the air and everything's up for redesign.
Maria, thank you very much. Thanks for your time. Maria Demertzis, Economy, Strategy and Finance Centre Europe leader at the Conference Board. We thank you very much for your time. Now, transatlantic tensions flaring up then over Greenland.
Right now, we are the hottest country in the world. We are the strongest country in the world. The Europeans project weakness. The U.S. projects strength.
US Treasury Secretary Scott Bessent speaking on NBC's Meet the Press there, not saying things that will be risk on for markets, which has often been the case in the past. Coming up, we will be heading back to Davos, where Donald Trump's designs for Greenland loom large over the whole agenda, of course. This is Bloomberg. Welcome back, everybody. 7:44 here in London, 8:44 if you happen to be watching from Davos. Good morning to you. You've tuned in for negativity across European equity markets because, of course, of the tariff threat we've heard about from President Trump over the weekend. European equity markets are expected to open in the red. We'll in particular be looking for some negativity around the big exporting names in Europe, of course. Now, US and European futures are falling, while haven assets such as gold are rallying after President Trump announced tariffs on 8 European allies that are opposing US plans to take over Greenland. The threats set up his visit to the World Economic Forum in Switzerland, where his appearance is likely to dominate. Let's head over to Davos, where Bloomberg Horizon's anchor Jemana Besetcha, we've seen her once already this morning. She's there. She's standing by with a guest. Jemana, good morning.
That's right, Anna. That's right. Good to see you. Well, this time I'm joined by a guest, and I'm very happy to say that InvestCorp Chairman Mohammed Alardhi is joining me right now, actually our first guest for this year. So there's a lot to talk about, maybe just in terms of expectations for the week, but also the setup going into the forum this week, and the fact that we are actually in a backdrop of extreme uncertainty. Geoeconomic confrontation was one of the big risks that came up in the global risk report. Over the weekend, we had President Trump once again threatening European countries with extra tariffs, and I just wonder, as a long-term investor, how do you think about deploying capital over the long term where there's so much short-term uncertainty?
Jemana, thank you. It's really great to be with you here. Well, I think we look globally that the baseline is constructive, because wherever you look, whether in the US, whether in Europe, whether in the Gulf, whether in India or Asia, people or governments and economies are really concerned about bringing costs down, ensuring productivity is up, making sure that these environments continue to improve. Now, obviously, uncertainty is there, but I think we look at value everywhere, and there is value everywhere in pockets. In the United States, for instance, I think what's going on in terms of the stimulus, in terms of the focus on technology and AI, some of the things that made tax codes permanent is really helpful for business, but also the approach about looking at affordability. All these things are to make good business and investment environment. So basically, we see value everywhere in pockets.
Do you think private capital is going to play even more of a stabilizing force over the next couple of years as countries have to deal with the rise of protectionism and look inwards?
I believe so. I mean, as you know, InvestCorp has always really been a bridge for private capital from the Gulf outside and from outside the Gulf inside. And it's a patient, I think, capital. It's something that really reduces volatility, especially in times when you do need patience with capital. You do need thoughtful processes in ensuring that you invest through crises and cycles.
Yeah, so you're a homegrown Middle East investment fund, and I'm curious to hear how you see the opportunity set right now in the Gulf. I mean, you have countries like Kuwait also looking to open up as well. I mean, how are you seeing the opportunity set specifically in the Gulf? You've been there a really long time.
So we look at the Gulf as really an ecosystem. for us. It is definitely a very compelling long-term investment market in this global economy. I mean, you have clear policies, you have sovereign balance sheet that is really strong, you have capital, you have huge economic transformation agenda. And so we in the GCC, we focus on a couple of things. We focus on companies and private equity. There is a maturing private equity coming along in the Gulf. Strong partnership in there. We also focus on infrastructure. And you've probably seen some of our talk in the media about partnering with the likes of ADNOC, Aramco, and in the Duqm port on things around the infrastructure for these big projects.
What about the potential for listings in the region this year and the potential exits on some of your portfolio companies? Again, always a big question.
Well, I think the IPO market is improving in the Gulf for sure. I mean, Oman, for instance, was one of the high growth markets last year. But I think even globally we see an improvement in IPOs markets. We were in Hong Kong, for instance, just a few days ago, and there. It was the number one IPO market in the world. There's a backlog of something like 400 companies. That market had an injection of something like 700 billion of AUM in the last 12 months. So I think things are moving in the IPO market globally.
Yeah. At the same time, do you think that the industry as a whole has had to undergo a period of transformation in terms of what's realistic, in terms of holding periods, in terms of realization, monetization of the portfolio, simply because it has been slower the last couple of years?
Yeah, I mean, I think now for sure. I think it has seen a change, obviously with high interest rate, with investors being cautious. I think the value now is really in value creation in private equity, is really in ensuring that strengthening the investment teams, ensuring that you go through the quality that you know, and align with those drivers of growth everywhere.
Yeah. And in terms of sources of capital, there's been a lot of chatter about potentially opening up private equity to new sources of investors, even retail. How do you feel about that? And do you think it would be a constructive step for the industry?
We believe so. I mean, I think there's a lot of talk about credit. There's a lot of questions about credit. But what we have a big credit business. We have mainly in CLOs, over $23 billion. And I think you have in the credit, you have these, big companies that we don't see any problems with because there's a lot of diversification. I think in the bottom you see also SMEs where there is a lot of obviously due diligence and clarity in there. I think the bit in the middle where one need to be careful. But again, I think the drivers of the economies and the growth that we see should make this a good business.
Okay. Well, if you rewind back to exactly a year ago, I believe you and I were talking and you mentioned the possibility of perhaps a liquidity event. Can you give us an update on potential IPO or strategic investor?
Well, for InvestCorp Holding, we continue to think about these things. As you know, like any other investment firm, thinks about liquidity. But there is really nothing concrete at the moment because we are really happy just doing what we're doing and growing the way we're growing.
Okay, sir. Thank you so much. Always a pleasure to chat to you.
Thank you.
That was Mohammed Alardhi, the InvestCorp Executive Chairman, speaking to us on this first day of Davos. And of course, uncertainty, one of the big themes here. Back to you guys.
Yeah. Absolutely, as ever, but even more so after the weekend. Jemana, thank you very much. Jemana Besetcha with the InvestCorp Executive Chairman in Davos. Plenty more coming from Davos, of course. Plenty more on the market open too, Tom. We're 7 minutes away from the start of equity trading and certainly focus on European stocks that could be weak as a result of this tariff threat from President Trump. Yeah,
the exporters, of course, in focus. So the luxury goods makers, the automakers as well could face pressure in the session today, given that threat of additional 10% tariffs that could kick in from February the 1st, could, of course, and then they could rise to 25%. That is a threat, at least from President Trump. And, of course, we know European leaders are looking at their own retaliatory measures. So, yes, European exporters likely to be under pressure. I wonder where the havens are across European equities and whether defence and banks play that role.
Yes, and I mean, I was thinking about where, the Chinese data has also come out, and sometimes we see London reacting to that because of the basic resource stocks. But actually, some of the metals pricing moves we've seen this morning have conflicted with each other, not necessarily getting a clear read there, and not a big growth story that we didn't know about coming through in the Chinese data. So maybe that won't be a focus. But London looks as if it will be more insulated from these tariff moves just because of the sector breakdown of the listed universe in London. So autos in Germany will watch for that. Luxury goods in France will watch for that. Bayer could also be in focus as well. But that on the upside, actually, after getting some more positive news from the US Supreme Court. So that could also be in focus. So a lot going on this morning, Tom.
European futures currently pointing down by 1.6%. All of those idiosyncratic stories behind and below the hood as well. It is the open trade coming up. Stay with us. This is Bloomberg.
Morning, everybody. A few minutes to go then until the start of trading, cash equity trading for this Monday morning. It is a US public holiday, of course, so we're without the US in terms of cash trading later on today. So let's focus in on the European session that is just minutes away. And I'll show you what happened on Friday in the United States. But really, just so I can say that it probably will have very little bearing on what happens in Europe today. Often we have to play catch up with Friday's session. Today, the weekend narrative, of course, has overtaken us, and that will be much more to the fore. So let's have a look at the futures picture and show you where we are there, and we are weaker. The FTSE 100 futures looking more resilient, down 0.5%. DAX futures down 1.3%. CAC futures down by 1.7%, 1.8%. So we are expecting to see considerable weakness coming through, in particular in those sectors, in those companies that do a lot of exporting to the US. We've yet to hear a definitive response from Europe. We might not get that early this week. That might come later. European leaders are meeting later on this week. But of course, whether we see retaliation there will be important to US stocks later on in the day, of course, as well. Euro Stoxx 50 futures then, Tom, are negative, down by 1.6%. Take us through some of the stocks we're focused on.
Some of the individual names that are in focus for us today. This is one story that's not, in fact, linked to the tariffs, which is Bayer. And this is on the back of a ruling that came through on Friday. It could be significant for this company and others within the chemicals and fertilizer space. This is the US Supreme Court agreeing to hear that German company's appeal, taking aim at those thousands of lawsuits that have been targeting, of course, the Roundup weed killer. So that is important for Bayer. But beyond that, it is all about tariffs and trade. That is the key driver. So watch for the luxury stocks, LVMH in focus, the automakers as well, on the threat of additional tariffs on those goods being shipped into the US market, Anna.
Yeah, and we've already heard from Europe that the ink is not yet dried, not even been signed on the trade agreements that have been made across the Atlantic. Now they have been put on pause. That conversation with the European Parliament put on pause, not approving those and considering dusting off some other measures, some tariffs on US product instead, up to the value of 93 billion euros, we understand. Let's have a look at how European equity markets are dealing with this new renewed tariff news flow. Yes, last year was very much dominated by the tariff conversation, of course. Certainly the month of April very much dominated, and we worked our way from there through a lot of the issues around tariffs. Maybe we thought we'd park tariffs a little bit for now. Maybe we thought things were more predictable. It seems that was not the right assumption, and things are not predictable when it comes to the tariff conversation. And now we see tariffs weaved in with the geopolitical agenda surrounding Greenland, and that is to the negative for European companies. So the Stoxx 600 down by 1%, the FTSE 100 down by 0.5%, CAC stocks over in Paris down by 1.6%, the IBEX also a little bit weaker, waiting to see what happens on the DAX and on the SMI. We could get some weakness on the DAX, of course, because of some of those auto companies that you were talking about, Tom, just a moment ago. The SMI, well, the Swiss currency might behave as a bit of a haven. We were hearing from Goldman Sachs earlier on today. We'll see what people decide to do with the drug sector, with food and beverage companies, whether there will be any havens to be found within European stocks, or we have to look to other assets, to bond markets, for example, to find those, Tom. What are you seeing in the sectors?
Yeah, we're seeing that divergence as well at the index level. Interestingly, to your point, the FTSE 100 down 0.4%, but bearing and faring much better than its continental European counterparts, despite the fact that the UK is targeted, of course, by those tariffs as well. On a sector basis, the worst selling is coming, the strongest selling coming through for consumer products, down 2.3%. Banks also, interestingly, under pressure. 1.7% is the drop there across that sector. Financial services, technology, all being hit, all down more than 1%, significantly more than 1%. Travel and leisure down 1.4%. In terms of sectors in positive territory, just one sector so far, that's personal care and products, just marginally gaining. Utilities, often a safe haven tilt into utilities. That sector is down 0.3%. Again, one of the least bad performing. The defence names are on the rise. You're seeing that with the FTSE 100 and BAE Systems, Anna, gaining a little over 1%, and its European counterparts in similar territory then.
Yes, the movement of defence often hidden within the industrial goods and services sector, but we certainly do see some defence names doing really well this morning. So Saab is up by more than 4%. Rent Group, Leonardo, Hensoldt, Thales, Dassault Aviation, Rheinmetall, all of those up by more than 2%. So where we are seeing selling in auto stocks and luxury, we are seeing gains coming through for European defence names, as I suppose Tom might depressingly expect to see on a day like today. Consumer products and services then, obviously the luxury names are in there, and so that is where we are seeing some weakness, and you've been through some of the names there, but I suppose there is some defensiveness to personal consumption and discretionary and grocery stores. So Tesco's, M&S, Unilever are just a little bit firmer, but the gainers are few and far between today.
Again, that is leading some of those grocery names leading to that relative outperformance in terms of the FTSE 100. Again, still in negative territory, but some of those grocery names are doing quite well. Just briefly touching on the retailers, then Adidas down 4%, LVMH down 3.8%, Puma taking a hit down 3.7%. To your point as well, Hermès also under pressure by 3.6%, Anna.
Let us bring in John Turek, founder and CEO of JST Advisors, who joins us this Monday morning to think about the risk-off picture that we're seeing across global markets this morning. John, very nice to speak to you. So certainly very risk-off into the European session. European stocks looks as if they will come off worst, very much targeted by President Trump, of course, in those 8 countries over the weekend. How are you thinking about trade and tariffs and the tariff threat as we move into 2026 then? Does this reinsert itself back to the top of our worry list for European investors?
Yeah, and thanks for having me. And I think it has to. One, not only given the severity of sort of these tensions, as we'll probably hear more from this week, but also from the fact that, I think for a lot of allied countries who signed trade deals in the middle of last year, this is sort of a shock to the system in terms of, what it kind of means to what an agreement actually means. So I think it does, kind of bring it back to the forefront. I think, the bigger question for risk assets is going to be, we had this idea of taco last year. And is that sort of going to be the default parameter that we kind of operate under, or is this, something that's going to be a little bit stickier? And I think, I think this week we'll learn a lot in terms of how markets and their disposition sort of reacts to that.
Yeah, that's really interesting, because if we're thinking about the feedback loops, the feedback on the policy that President Trump will receive, it'll come from many places. It'll come from politicians globally. It'll come from domestic politicians. It'll also come from markets. US futures point lower, John. We will see how this plays out for bond markets, of course, because there's been some nervousness around the bond markets and the feedback loop that represents. What do you think President Trump will be looking at ahead of the midterms that might steer his course here?
Yeah, well, I think it's a very interesting tension that the administration kind of has to solve for, because they seem to have this, I would say, full-forced effort into not only juicing the economy into the midterms, but also kind of, this more grander vision of national resilience, reshoring global supply chains, and then sort of, broader U.S. exceptionalism. The problem is that, to achieve some of these things, it's a very hard equilibrium to kind of strike. And I think the problem that the administration will have, especially, is what I kind of, differentiate tariffs between allied tariffs and adversary tariffs. And with allied tariffs, you have to deal with the fact that the Allies own a lot of U.S. financial assets. And the question that we began to wonder last year was either between hedging or outright selling, the U.S. could appear vulnerable if some of these larger pools of foreign capital decide that this is a little bit hairy. So I think the tension that the administration, I think, is going to try and toe, is U.S. exceptionalism versus, U.S. for sale. And I think that will be, something that will probably not be an either or, it'll probably be a balancing act, because I do think, it seems that some of these geopolitical and national security issues are something that are just very top of mind for the administration. I don't think it's a 10 bips sell-off in the long end or a 2% down day in the equity market that's going to necessarily mean the end of these prerogatives.
To your point, John, it's difficult to know who is an adversary and who's an ally at this point in terms of the perspective of President Trump. Do we get to a point where this cements, at least in the minds of some investors, a sell America theme?
Yeah, I don't know that it'll do enough to, a broad sell America theme. I think, something that I've been, talking about in notes to clients is that, I think that the rest of the world came into this, Trump 2.0 world very leveraged, very long U.S. assets, and a lot of it being currency unhedged. And I think that, the question you have to ask yourself as a foreign investor is that even if you, don't want to necessarily part with, some of the big secular winners that have come out of the U.S. in terms of equity markets, credit markets, et cetera, it does seem like it does make sense to at least hedge a bit more of the FX exposure, especially as U.S. interest rates, at least in the front end of the curve, have come down recently. So I think that, I don't know that this is enough to kind of have a bigger rethink in terms of, not being exposed to the U.S. properly, especially as so much of the returns in financial markets over the last 10 years have been so U.S.-centric. But I think the question that is very reasonable to ask, especially for, I'd say these allied countries who hold a lot of U.S. assets with record low hedge ratios, is that the right mix for this sort of geopolitical landscape?
What assumptions and how does it change? How should it change our assumptions about the reaction function of the Federal Reserve, John?
Yeah, so it's a good question. I mean, I don't think it'll change that much right now. I think, the Fed is very much in wait and see. I think they probably have a slight bias towards labor market weakness being versus, too worried about inflation at this point. But, I think that, we're in over these next 2 months, probably in the peak of sort of this tariff impact on the price level. And the question is that if the tariff playbook is sort of back in play and the go forward rate of tariff could actually be higher, is that this is going to be a little bit more lingering when the Fed thought, by the middle of this year, that price level adjustment would have been done. But I think in the near term, I think, the labor market is still a little bit more front and center, given that the inflation pass-through from tariffs has been, I would say, more muted than versus expectations.
Can I ask you about FX markets and how they are going to respond here, John? We've talked this morning about how the dollar has come off as the loser, and that does seem to still be the case. I'm looking at the Bloomberg Dollar Index, the DXY, both of those have the dollar down. The euro is gaining 0.2%, as if the euro gains, yes, they're there, but they're fading just a little bit. I wonder if the negativity around the start of trade here in Europe has anything to do with that, whether that weakness is sort of feeding off other assets. How do you expect this FX story to play out?
Yeah, it's a very interesting one right now. I think that, again, kind of coming back to my point earlier, it's these allied tariffs versus adversary tariffs. For adversary tariffs, I think the reaction is very simple, one, because they're oftentimes big exporters. It's FX weaker because it's, just the U.S. is much more immune to global trade concerns, given that so much of the economy is based off of domestic demand. But with the allied countries, they own a lot of U.S. assets. And, we've seen over the last, 7 to 10 years, this really massive buildup in the U.S.'s net international investment position. And I think that, the balancing act that FX is going to have to play with is that on the one hand, we could do this, quote unquote, sell U.S. theme on the back of just adding an incremental risk premium versus that, the U.S. is just, from an economic perspective, much more immune to both headline risk and global trading risk, given that, trade makes up a very small percentage of the U.S. economy. I think that, given the level of adjustment that could happen within FX hedges, I think that the dollar marginally should trade softer on these sort of headlines versus weaker, even though it could sort of exacerbate U.S. growth outperformance.
John, I want to get your views on Europe. I mean, we're seeing, again, defence names rallying today on that kind of geopolitical risk and expectations, presumably, that there's going to be more funding and more need for domestic providers of defence in Europe. There's a debate now as to whether or not the pressure from Trump catalyses faster and deeper reform. And we're seeing, at least across political boundaries, unity right now, and we'll see if that holds. Is it too early to start to think as an investor about how to invest along a more unified Europe?
Yeah, so I don't think so, to be honest. I mean, I think that, as we know from Europe is sort of, formed in crisis. We saw last year that the German fiscal announcement was very linked to sort of how the Zelensky White House meeting went. And that was obviously a very pivotal and monumental moment. And I think the question, that investors will have to think about, going into this year is that, the paradox of negative European headlines is that it can deepen structural reforms that are very much needed, both in terms of capital markets unions, continental integration, things of that nature. And if Trump can sort of paradoxically be a bullish catalyst for some of these structural reforms, I think that's very top of mind for me going forward.
OK, John, smart insights. Thank you for your time. John Chirek, founder and CEO of JST Advisors. Let's get you your core six then, on a day when we're weighing up these renewed trade tensions then between the EU and the US. We talked about the defence names performing very strongly. Here are some of the individual names as well standing out. Rheinmetall, there you go, the performance there coming through. 1.7% is the gain so far for that German defence company. ASML within the tech space taking a hit, down 3%, despite some positive upside, or at least commentary from Micron around high bandwidth memory. ASML, the maker of lithography machines, under pressure, falling the most across your core six right now, or almost. In fact, LVMH is the standout drop there. The luxury goods maker down 3.7%. Novo also taking a bit of a hit within the drug space, down 2.7%. Schneider Electric also selling off. And Nestle off just 0.4%. Sometimes staples have that defensive quality. But Rheinmetall on the upside, and the pressure coming through from LVMH. Let's get a check on some of the other individual stocks on the move and bring in Bloomberg's Jennifer Crew. Jennifer.
Good morning. We're going to kick off with a look at automakers. Automakers down in the red this morning. Volkswagen down almost 4%. Mercedes-Benz down more than 3%. That's off of the back of the news that President Trump is proposing 10% tariffs on 8 countries, including the UK, Germany, Sweden, countries that opposed his plans to acquire Greenland. Those car makers seen as particularly exposed to that directive. We're going to flip over to defense, of course, keeping in that geopolitical theme. Defense stocks up higher this morning. That's Fresnillo up almost 5% on the back of that news about those tariffs. Those companies seen as best placed to benefit to capture some of those orders from European NATO members, including Denmark. Those countries set to ramp up their military presence in the region, including in Greenland. We're going to flip over to miners, of course. That's Fresnillo, Anglo-American, Glencore, some of those miners up as investors move towards those safe haven assets. Of course, this is a period of geopolitical uncertainty, investors looking for a bit of security on the back of that. Next up, we've got LVMH, of course. LVMH downgraded by Morgan Stanley, saying that a pause for breath is needed because of limited room for LVMH's shares to appreciate in the near term. LVMH seen as facing a lot of pressure, particularly in its wine and spirits unit, but also some pressure from FX and tariffs. Finally, we're taking a look at Bayer. We're ending on Bayer. That's after the US Supreme Court agreed on Friday to hear the German company's appeals for thousands of lawsuits alleging that the company failed to adequately warn consumers about the cancer risks associated with its weed killer. Those shares up 7% on the back of that.
Jennifer, thank you very much. Jennifer Crewe with the latest on some of those moves. We will also take a look geographically at what we're seeing across these European equity markets. And we've got some of the Scandinavian markets in particular under pressure this morning. So I can see that the Danish market, the Finnish market and the Swedish market under considerable pressure. The OMX in particular in Copenhagen down by 2.5% this morning. Coming up on the programme, we will check in on the European economic outlook and possible response to Donald Trump's tariff threats over Greenland. Greenland. Our interview with ECB Vice President candidate and former Bank of Portugal Governor, of course, Mario Centeno. That's coming up next. This is Bloomberg.
Welcome back to the opening trade. Happy Monday, everyone. We are 19 minutes into the Monday session. European stocks selling off then on this renewed tariff risk from President Trump around Greenland. 10% is the threat of additional tariffs on 8 members of the European Union, NATO allies, of course, from February the 1st. And we're looking at big moves, of course, across the exporters of Europe. The automakers, luxury, under pressure, but defence stocks are rallying. Talking of defence names, Germany and the finance minister there speaking in the last few minutes. We know that President Macron has called potentially for the use of the anti-coercion instrument that Europe has at its disposal. Now the Germans suggesting they could be supportive of that. The finance minister of Germany saying that a red line has been reached and due to Trump's provocation, Europe should look at how to use available tools. OK, thinking about how Europe responds, the European Union easing talks to potentially impose tariffs on $93 billion of US goods in response to President Trump's proposed levies on several countries over Greenland. EU leaders will hold an emergency meeting in Brussels later this week as Europe braces for one of the toughest tests of its transatlantic relationship. Let's bring in Mario Centeno, who is running for Vice President of the ECB, former Governor of the Bank of Portugal, somebody, of course, who watches very closely the European economy. Mario, very nice to have you with us. Thanks for joining us. How should monetary policy makers, do you think, be reflecting on the news flow over the weekend?
Oh, thank you for having me. Europe and the euro area have entered a phase of structural uncertainty. This has been driven by geopolitical and trade tensions of the sort we have seen in recent days. But on top of that, we face competing fiscal demands related to defense, climate, and digital investments, and the prospect of abrupt changes in the structure of our economies and labor markets. These are not big, small challenges. So directly to your question, I think European Union institutions will increasingly be called upon to act as a stabilizing actor. And this very much applies to the European Central Bank and to monetary policy. It would be great if Europe can continue this coordination of policies that we achieved in recent years, because really the challenges are very, very big. Okay. So monetary policy should act as a stabilizer, you think, Mario. What if European politics dictates that the Commission responds with retaliatory tariffs? How should monetary policy respond then? Well, we have a mandate, which is price stability. Some of these policies and the shocks that we are facing, they have an impact on prices. So the best thing that could happen for all of us would be to each dimension of economic policy to do exactly what is expected for it to do. So monetary policy should continue to look for price stability. This is our mandate. But we do understand that it's very important for us to keep that in mind, that the coordination of policies helped us a lot to go through the COVID and inflation crisis. And these challenges that we face today are not smaller. So we need to, expect that this, how I put it, this stabilization anchoring from policy can really be on the table. Mario, in terms of that stabilization of policy at the monetary policy level, if we do get to a point where tariffs are imposed between the US and Europe, should the ECB consider additional rate cuts this year? Well, it's all about inflation and financial stability. We want to have financial stability because it is a prerequisite of price stability. If tariffs really have an impact in prices that will take us to reduce cuts further, that will be our job to do so. The important thing here is to understand that each piece of these common policies in Europe play together in a way that delivers for us, because that's quite important for Europe, the stability we need to go through these very difficult moments.
And we want to get to your candidacy, Mario, in terms of the European Central Bank vice president role, and of course you'd be representing in that role, should you get it, the southern Europe. What would you bring to the table? What kind of voice would you bring that doesn't exist right now at the ECB?
Well, it will be a voice that brings all this experience of dealing with very difficult challenges, the financial financial crisis as a minister, then as a governor, COVID and the inflation. Also a voice of consensus. This is probably my most well-known trademark. Is I'm striving always to get a consensus in a council that works in a collegiate way. So this will be my best credentials to the job.
That would be your credentials. And how do you assess your chances, Mario? Are you confident, quietly confident?
I mean, this is a very important day. It's up to ministers to the selection. I think the large pool of candidates is a good thing for Europe, because there's plenty of choices. They are all my former colleagues. I have great appreciation for all of them. So honestly, I think it's just we should celebrate the fact that there are many alternatives around to be selected, and if each one of us concentrate on what are their specific characteristics and qualities to the position, that's I think what's important.
Mario Centeno, former Bank of Portugal governor and candidate for Vice President of the ECB. Thank you very much indeed. Coming up, we're going to speak to Leslie Finjamuri, President and CEO of the Chicago Council on Global Affairs. Stay with us. That is next. This is Bloomberg. This is the opening trade. We are 30 minutes into today's session. This is the market reaction then to that economic coercion from the Trump administration. European stocks across the benchmark down 0.8%. The DAX, despite the defence names performing quite strongly in the session today, as an index falling more than 1%. There's relative resilience in the FTSE 100, and defence is playing its part there, with BAE Systems gaining down 0.1% just for the FTSE 100. The CAC current over in France dropping 113 points. Let's flip the board and have a look at what's happening in terms of some of the volume on a day, of course, when the US markets are closed for a national holiday. So of the 600 across that benchmark in Europe so far, I touched on volume, so let's start there. Actually up. Volumes are actually up about 40%, in fact, despite the fact that the US is closed for that market holiday. But all that uncertainty around the tariff risk and threat from the Trump administration. Across your 600 members, then just 116 in positive territory, and we'll get into who those are. On the downside, 473 stocks now under pressure and selling off in the Monday session. Let's flip the board and have a look at some of the leaders then. I talked about the defence names, on that geopolitical risk, the focus on Greenland, the threats of military intervention. Rheinmetall at 2.4%, that German defence company, of course. BAE Systems here in the UK gaining more than 1%. And buyer, this is separate to your tariff story. This is separate to the Greenland story. This is on a ruling from the Supreme Court in the US that they will look at those cases targeting buyer. So that is seen as positive for that company, gaining, look at that, almost 8% in the session today. On the downside, we expected this, of course, on the Trump tariff threat. The exporters to the US market with 10% additional tariffs potentially kicking in on February the 1st. So the luxury makers, LVMH down 3.8%, Richemont falling 3%, ASML as well. Tech is also under pressure in the session today, and so the maker of those lithography machines down almost 2% as well. The Dutch company not immune to the pressure coming through in this risk-off environment. Anna.
Tom, let's get an update on some of the other stories this morning, and we start with a story outside the world of business and finance. A high-speed train has derailed, jumping onto the opposite track and slamming into an oncoming train in southern Spain, killing at least 36 people. The crash happened last night when the tail end of a service travelling from Malaga to Madrid went off the rails near Cordoba. Former UK Prime Minister Tony Blair, who's been appointed to the executive panel of Donald Trump's so-called Board of Peace, has distanced himself from the president's demand that countries pay $1 billion for permanent membership. Separately, Israel has voiced objections to the makeup of the Gaza Committee, which sits under the Board of Peace. And Bloomberg has learned that the European Union is in talks to potentially impose tariffs on 93 billion euros of American goods. That's if US President Donald Trump follows through on his threat to hit several European countries with a 10% trade levy. EU leaders are set to hold an emergency meeting in the coming days to explore possible retaliatory measures. Tom.
Let's head to Brussels right now to get more on that story. Let's bring in Bloomberg's Chief Europe correspondent Oliver Crook, who's standing by. Ollie, we've been hearing from the French, we've been hearing from the Germans, the French finance minister saying a red line has been crossed in terms of France le secure. Over in France saying that minister saying we need fast and significant reaction to Trump. So for now there is unity in terms of pretty sustained pushback, at least rhetorically, and whether or not they reach for that so-called bazooka in Europe. Talk to us through the European reaction to this tariff threat.
Yeah, I think it's one that's been overwhelmingly of European unity in the response to Trump and those comments that we got on Saturday evening, basically imposing 10% tariffs from February the 1st on 8 European countries, including France and Germany, Denmark, Sweden, United Kingdom, Netherlands, and some others, basically for their support that they have lent to Greenland in the form of basically symbolic military presence in Greenland, which is about sort of building out security there, which is, of course, at the behest in some way of the President of the United States. That 10% tariff goes to 25% tariffs in June. And I would say that what has marked the difference now between the trade war that we saw earlier between the Europeans and the Americans is the rhetoric here from what we're hearing from the Europeans is much stronger. I think that with the trade imbalance question previously, which is what the Trump administration was trying to write, it was fair to say that there was trade imbalance between Europe and the United States. This is not seen as a legitimate way by the Europeans to use the trade tool, not to rebalance the trade balance, but actually to exert basically geopolitical pressure on the Europeans. And so the word we keep hearing over and over again, we've just heard it from the French, we've just heard it from the Germans, is blackmail. So the question is, how will the Europeans respond? Is this the red line that will cause the Europeans to finally push back? They've really rolled over the past year of Trump's presidency, giving the president basically everything that he wants. But it's hard to imagine a world in which you get February the 1st, 10% tariffs, and then the Europeans can't respond. What we know they have locked and loaded to go is about tariffs on about 100 billion euros worth of goods. That's ready to go because from their negotiations from early in the year, there's this issue of the anti-coercion instrument that the Europeans could deploy in order to basically move more quickly on a number of different trade issues, but also U.S. tech companies. But I think for the Europeans, it is sort of being thrust into focus right now. If no deal with the Trump administration is final, how far will appeasement take you? And that is exactly the balance of risk that is going to be on the table for European leaders who will be meeting here in this building on Thursday, and European finance ministers convening today and tomorrow, who we're going to try to get some questions to figure out how to respond here from the Trump administration.
Yes, the response is going to be all important, isn't it, Ollie? And will it be different to last time? With that in mind, and thinking about the drivers, the motivation behind what President Trump has done here, lots of European leaders asked to meet or asked to speak to President Trump over the weekend after he made this tariff threat. Norway and Finland amongst them. They sent a letter asking to speak to President Trump. In response, they received quite an incredible reply, a letter from the US president. Take us through some of the detail there.
Yeah, a very remarkable letter from the President of the United States addressed to the Norwegian Prime Minister Jonas Gahr Støre, and I'll just quote from it. It's fairly short. He said, "Dear Jonas, considering your country decided not to give me the Nobel Peace Prize for having stopped 8 wars plus, I no longer feel an obligation to think purely of peace, although it will always be predominant, but can now think about what is good and proper for the United States of America. Denmark cannot protect the land from Russia or China, and why do they have the right of ownership anyway? There are no written documents. It's only about a boat that landed there a few hundred years ago, but we have boats landing there also." So add that to the list of reasons why Trump wants, jurisdiction and sovereignty, control over Greenland. There's, of course, the Arctic threat that is seen as a sort of legitimate concern by the United States, and I think the Europeans agree, which is why they want to negotiate with Trump on that point. There's the question of mineral resources. There is also the question about Trump legacy, expanding the borders of the United States. But if the real reason is that basically Trump didn't win the Nobel Peace Prize, I think very few people, certainly in Europe and probably around the world, see that as a legitimate reason to sort of eschew the goals of peace in order to take control of Greenland. And we should say that for the Norwegians, they also have a strategic island in the northern Arctic. So there is also a question about their own sovereignty that is somehow implicitly linked in this conversation, to say nothing of Canada. If the United States is saying basically we need control over the northern part of the globe, Canada is part of that in order to get out the Golden Dome, where is the sort of limit to how far he's willing to go? And that is a question for European leaders, but also for other leaders, including Canada.
Ollie, thanks very much. Bloomberg's Oliver Crook then at the European Council with the latest on the European response and some of the dialogue that's been happening between Europe and President Trump. Let's bring into the conversation Leslie Vinjer-Murray, President and CEO at the Chicago Council on Global Affairs. For more, Leslie, really nice to see you in studio with us today. Looking forward to your analysis. And let's start with that question we were discussing there with Ollie, the motivation behind what President Trump is doing here. Quoting Greenland, of course, extensively, and we've heard a lot from the President on that subject. Also, the Nobel Peace Prize now. But if we stick with the Greenland story, is it possible that President Trump has seen EU NATO members sending a few troops to Greenland as something threatening, when actually Europe had meant it to demonstrate the seriousness that they treat Arctic security? I mean, is it possible that is a misunderstanding that has happened here?
Absolutely. I mean, I think we all would have thought that this would be seen as Europeans doing more for defense and security. President Trump has clearly wished to see that. And instead, he's taken it as an affront that Europeans are challenging the president. And he's clearly ratcheting up and accelerating the threat. And so, the risk right now for Europe, I think, is how do you manage this president? And there's clearly a rapidly developing sentiment across European leaders, across European publics, that Europe should come together and take a strong line, that this will win the day. And the example is being drawn to China and others who have been more effective, especially at China, I think. But, there's a critical distinction here, which is that China has had real leverage with its threat to withhold the export of rare earth critical minerals. Europe doesn't have the same leverage. And so it's a very different calculation. It's not only clearly unity is important, clearly a clear response is important, but I think, sort of taking that case and plopping it onto the European case risks an escalatory trade war, which would do everybody harm. I think the other thing is to note that American consumers are increasingly going to bear the cost of tariffs. They didn't in the beginning. Towards the end of 2025, it was sort of looking at 50% costs deflected to U.S. consumers. We're looking at 60+%. So working through American consumers is, it's a long-term play, but it's probably a good one. Americans don't like what's happening in Greenland. They're not on the side of the president on this issue. So I think some really nuanced thinking is absolutely essential.
And what kind of response is President Trump going to get from Republicans, from his own party? Some of that response that's been highlighted over the weekend has been quite critical. I wonder how that is going to feed back into his thinking.
Yeah, and so here, the Republicans are dividing slowly on this. We've seen some divisions within MAGA on other issues. This is putting them in a very difficult spot. I think in general, if you were to talk to people privately and they were honest in the Republican Party, they would say they did not support this policy. There's no material reason that the United States needs to take over Greenland or possess it. Using military forces, widely opposed. But the question, as we know, for the past year has been who will speak out. And again, domestically, Americans, Republicans, what levers do they have to constrain the U.S. president? We're waiting for that Supreme Court decision on tariffs. If that ruling is against the president, that produces a delay. But coming back to this question of Europe and tariffs, there are two very interesting, significant products that Denmark exports to the United States. 100% of Ozempic comes to the United States. It comes from Denmark. 74% of insulin. Those are really critical products, differently critical, but really important products for vast swaths of Americans. Insulin clearly critical for the American health system. So there are levers, but it could be very risky to pull those levers.
Yeah. So the European drug makers, or at least weight loss drugs, could be our rare earths. As we look at the Chinese example of how to push back, maybe that's taking it too far. But there are levers that can be pulled.
There are levers, but there are workwourends. We know that there's a crowed market. There's a developing market.
Eli Lilly might be happy with that turnaround in events if that was to come. Would you be advising European governments to go for that so-called bazooka, that anti-coercion instrument?
I think you need to drill down on that. I've heard some people say that the anti-coercion instrument is not nearly as strong as it's made out to be in the media right now. So real question about what lever that is. And again, I think this is a moment for very, very savvy diplomacy. And there's likely to be a gap between the rhetoric and actually the instruments that are taken. And now, once you've got the European public, when you start talking about sovereignty, as you well know, Greenland and Denmark, you get the public angry. And so the European leaders are going to have to manage the public, their publics. They want to see a stronger response. The unity is critical. But my fear is that this could lead to a very, very escalatory trade war, which would have very negative impacts on Americans, American consumers, on Europeans, and comes at a time of great security challenge. So one doesn't want to see, the word appeasement not appropriately applied, but one doesn't want to see appeasement. But at the same time, Europe is not in the same position as China. It is a very tricky set of calculations right now.
How do you think Beijing and Moscow will be reading these events?
I mean, wonderful distractions. China, as we know, has got its eyes on the prize of global leadership, of its developing its economy strategically, managing Donald Trump very effectively. I think we are all surprised over the last year, and as reflected in the national security strategy, that the U.S.-China relationship is actually moderated. But when they watch Europeans fighting with Americans, hooray. I mean, a big distraction from the things that they wish to accomplish. And again, with the war in Ukraine ongoing, it takes America's eyes off the prize. It takes Europeans' eyes off the prize. It's really essential to get the transatlantic relationship back on track.
Yeah, but what do you think the word ally means in Washington these days, Leslie? Does it have any meaning at all? I mean, if you are trained in the world of business, then maybe it's a term that you don't see as all that relevant, and maybe that's what we're seeing playing out in politics right now.
Look, the word ally, it's a formal definition, and it's about the security part of the relationship. It's not, partners or kind of cover the broader relationship. But I think it's really critical to recognize the moment that we are in. Donald Trump is a singular leader, and he does not reflect, and we know this, right? The Chicago Council on Global Affairs has been polling the American public since 1974, and the American public's views are very strong on NATO. They don't wish to see military force used in Venezuela, in Greenland. The President of the United States does not track either with the broader Republican sentiment or with the Democratic sentiment or with the American public on numerous things, even though people have clearly folded to support him because he's got a huge amount of power and he's willing to bust through those norms in ways that are, quite frankly, threatening to people's individual security. So this is the challenge. And I think we all know that at the end of the day, getting the president to moderate in any meaningful way is something that Americans are going to have to do.
Do you think the bond markets played a role in April of last year when tariffs on Liberation Day were announced? We're not seeing that kind of reaction today, and that the level of tariffs is not at the same point. But at what point we're talking about the domestic political constraints potentially on President Trump's aspirations? Do you think the markets start to play that role as well, or has Scott Bessent now been pulled so firmly into Trump's orbit that even he is not going to be the one putting pressure on this president.
Americans at the high end, those invested in the stock market, are doing very well, the growth in the economy is very good. The jobs are, the rate of job creation appears to be coming down. That could affect people. And so I think you've got to differentiate between, upper middle class and wealthy Americans who are benefiting and those ordinary Americans who are feeling the affordability. The word of the day in the United States is affordability. This is where people are unhappy. This is where the administration has so far not delivered. But how does that actually have any sort of effect on the president? Not until the midterms. So there are very few points in which that sort of ordinary swath of Americans have real leverage, have real influence, and elections are the primary mechanism. But for now, broader pressure, the economy is doing very well. Everyday life, I can tell you, in the United States, we see and we hear and we know the stories about ICE. Everybody's watching Minneapolis. The president's considering using the Insurrection Act, potentially sending 1,500 troops in. The streets of Minneapolis are extraordinary to watch. It's upsetting to people. Yeah. But you've got a country in which many wealthy Americans are doing phenomenally well. And therein lies attention. Without that changing, it's hard to see the president moderating. He's delivering for the high end of the United States.
OK, Leslie, thank you very much indeed for your take on what is happening and how to think about it in a broader context. Leslie Vinjamuri, President and CEO at the Chicago Council on Global Affairs. Let's get back to the market reaction then. We've been talking about the fact, of course, that it is risk-off given those additional tariff threats coming through from the Trump administration, down 0.8% across a European benchmark. You are seeing gains, though, of course, for European defence names as a result of some of these tensions and fears maybe around what happens with the NATO alliance on the back of this. So you've got the likes of Saab, Hensoldt and Rheinmetall posting decent gains. On the upside as well, Bayer up 7.6% on a Supreme Court ruling. That's a picture across the European equities. Broadly, of course, it is selling pressure across the European markets on these tariff risks. Let's get you to break. We'll get more analysis across the markets as we square up to this economic pressure. Stay with us. This is Bloomberg.
Welcome back. This is the opening trade. Staying with our top story, Donald Trump's threat to impose tariffs on 8 European countries is shaking the foundations of the EU and NATO alliance. European leaders have strongly rebuked the threat, calling it blackmail. Defence stocks, then, as we may have expected, are on the rise this morning. Let's discuss the defence supply chain, what this means for European defence, with our global defence editor, Jerry Doyle, on set with us here in London. Jerry, good to see you. So do we take from the developments over the weekend that, there's more pressure on Europe to spend more on its own defence? Clearly, that's been the message for a very long time, though, now from the Trump administration and the first Trump administration. Does this mean less reliance on US defence names? What do we conclude from the weekend's developments?
It certainly seems like we're on that sort of a trajectory. If the U.S. sort of continues down this path of insisting that it needs to take Greenland by force as necessary, that sort of, shatters a lot of relationships, both at the governmental level and the military level. And it makes it very difficult for current European customers of U.S. defense companies to believe that they can continue getting the support and the parts and the other sort of supplies that they need to maintain complex weapons systems like jets, advanced missiles and things like that.
What is the level of reliance right now on that US military input into the European supply chain, and how easy or not is it for European defence contractors to find additional sources, either within Europe or places like Korea, for example?
It depends on the system. Something like Patriot missiles, there isn't really a European analog for that at the moment. There's sort of lower-end defense systems for air defense that you can get from Rheinmetall and Kongsberg and other European companies. But, a Patriot system that can intercept missiles, that's a little bit harder to replace. And then you have something like the F-35, a fifth-generation fighter. There are no other foreign suppliers of that in the world right now. If Europe wants a fifth-generation fighter, it has to have the F-35. Of course, European companies also make lots of different components of the F-35, so that complicates the supply chain from a different direction.
Okay. Joe, thank you very much indeed. As we look at European defence companies rallying in the session today, our global defence editor, Jerry Doyle, on some of the complexities around the defence supply chain. Let's bring in another view on the broader markets right now. We're joined by Skylar Montgomery Koning. Skylar, we're seeing risk off across the global, or at least across European equities. We lift the hood, and there's some idiosyncratic stories at play as well. Gold and silver getting another lift. Bond markets, not a huge amount of action there. What for you is the central focus right now across the market reaction to this?
Yeah, I mean, it's quite interesting. I think the number one kind of feed through is the growth channel, right? Because if you have higher tariffs, that's negative for growth. So you're seeing that very clearly within equity markets, and particularly within the sectors that will be most impacted. So I think it's interesting that you are getting kind of a more targeted market reaction in terms of autos aren't doing as well, defense is doing better. UK is doing better than Europe because there's more miners and you have gold there. And it's not this kind of broad sell-off everywhere. It does seem to be very targeted because these aren't as big as the tariff threats we've had previously.
Yeah, that's interesting. And does that explain why government bonds are not quite the haven that they've been? I was expecting to see a bit more flight into German bunds, for example, and we're not really seeing that. We're seeing a bit at the short end, but just 2 basis points of a move in German yields.
I think that's partly where do I want to hedge. I want to hedge mostly in commodities because that's the main feed-through channel, and I think that's market's expression for a while now. I think the other issue is that we've been here before, right? We've had the taco trade. We don't know whether this is sustainable. The actual implementation date is until February 1st, so we don't have tariffs actually being implemented right now. And the worst case scenario is that we do have a 25% tariff put on Europe, which isn't as bad as what we've had previously. Now, you could talk about much, much worse scenarios, but again, those are low probability, high impact events that are very hard for the market to price.
Yes, I mean, the euro is a little stronger this morning, Skylar. Does that sustain, do you think?
I don't think so. I mean, we saw last year a very big flip in the dollar's reaction function and euro dollar as well to tariffs. So initially on Liberation Day, when there were broad tariffs imposed, the market reaction was that it was dollar negative because the U.S. was starting a trade war with everyone. Yeah. So all U.S. exports would be impacted versus just European exports to the U.S. What we've seen is that because the U.S. has more bargaining power, these other countries have been willing to take on higher tariff rates and the economic cost, especially because they are more export reliant versus the other way around. And so this is just the U.S. versus Europe. And Europe is more struck.
Thanks, Skylar. Skylar Montgomery Koning from our Markets Live team. That is it for the opening trade. The Pulse is up next with Francine Lacqua anchoring live from the World Economic Forum in Davos. This is Bloomberg.